Hello everybody and welcome back to GMD Investments. Today in the final part of the analysis of a business, we're going to be looking at the cash flow statement. Now, when looking at the cash flow statement, we need to understand that there is a huge difference between the business that grows and requires a lot of capital to do so and the business that grows and doesn't require capital. The business we're looking for is the second part of the thing that I said. So it's basically lots of a business that grows and doesn't require capital. That's what we're looking for. So the first thing I'm going to be running through today is capital expenditures. Capital expenditures is basically outlays of cash or the equivalent in assets that are more permanent in nature and is held longer than a year, such as property, plant and equipment. So basically there are assets that are expensed over a period of time greater than a year through depreciation or amortization. Capital expenditures are recorded on the cash flow statement under investment operations, as we can see on here. If capital expenditures remain high over a number of years, they can start to have a deep impact on earnings. So Warren Buffett himself discovered that if a company historically is using 50% or less of its annual net earnings for capital expenditures, it's a good place to look for a durable competitive advantage. The next thing we're going to be looking at is stock buybacks. Now, this is very important when looking for a company with a competitive advantage. Since shareholders have to pay income tax on dividends, stock buybacks is a much better way to increase shareholders' wealth without paying any tax. Buying back shares reduces the number of outstanding shares, which increases the remaining shareholders' interest in the company and increases the per share earnings of the company, which eventually makes the stock go higher. Lower share outstanding means higher earnings per share. It is found in the cash flow statement under the heading Issuance Retirement of Stock Net. In my opinion, I actually much prefer stock buybacks because, like I said, dividends, you have to pay tax on that. Whereas stock buybacks, you don't pay nothing. You know what I mean? And it's just, I think, is actually a lot more of an effective way of sort of raising the stock price over time. If we look at companies like Apple, Google, they all have, Occidental Petroleum is another one that I like, which is an oil company, and they pay huge buybacks. Chevron, they do the same thing. It's basically when a company, it runs out of, when a company gets so large, it runs out of ways to kind of allocate their capital. They have so much sort of money that's generated through their earnings that they're sort of sitting there thinking, there's not many ways that I can I'm running out of ways to put this into investments. So what better way to either pay dividends or a better way, which is stock buybacks, where they don't have to pay no tax, which can increase your shareholders' wealth, because that is really what you want to be doing as a sort of a CEO of a company is really looking after your shareholders is very important. Okay, so now I want to look at how to value a business. So when to buy, when to sell, pretty much. So if we look at the first thing I want to talk about today is equity bond. So I basically look at its pre-tax earnings and ask if the purchase is a good deal relative to the economic strength of the company's underlying economics, and say the price being asked for a business. Some days the stock market is pessimistic, some days it's overly optimistic. But in the end, it's long-term interest rates that determine the economic reality of what long-term investments are worth. So determining the right time to buy a business is very important. The price you pay directly affects the return on your investment. So when do you buy into them? The answer to that is in bear markets, because even a company with a durable competitive advantage can screw up and do something stupid that will send their stock price downward over the short term. When do you want to stay away from the super businesses? At the height of bull markets, when they're trading at historically high price to earnings ratio, which if you remember in the first video we looked at, I would say that an extremely high P ratio would be anything above 40. That's when it's getting sort of speculative and you want to stay away from it, which is going to be your sort of bubble, kind of, raging bull markets. That's when you want to stay away from it. I actually think that in sort of high bull markets and speculative sort of markets, what you want to do is you want to stay away from buying any stocks and just build cash, because the more cash you build, the more sort of opportunity you have for when these markets do drop off, which they will, and they always do, and the markets do crash or they correct themselves. You have enough cash, you're sitting on enough cash to deploy at the right time, at the right opportunity. So this is really what I would be doing. Okay, so we've talked about when to buy a business. Now we're going to be talking about when to sell. In the world of investing, when you have a company that has a competitive advantage, you shouldn't really be selling it. The simple reason is the longer you hold them, the better you do. Also, if at any time you sold these investments, you would be inviting the taxman to the party. Inviting the taxman to the party too many times makes it very hard to get super rich. The only advantageous time to sell would be if you need the money to make an even better investment at a better price. The second is where the company looks like it's going to lose its competitive advantage. This happened with newspapers and television stations. Both of them used to be fantastic, but then the internet came along and suddenly the competitive advantage was called into question. The third reason is during bull markets, when the stock market is in an immense buying frenzy, sending the price of these great businesses through the ceiling. Like I said, P ratios of 40 or more would be a good indicator of this. Another thing I want to talk about is companies with a AAA rating. This is basically the highest rating that S&P gives a company for its financial soundness. It doesn't get any better than this, basically. The company is golden if it gets this rating. The only two companies with this rating is Microsoft and Johnson & Johnson. Apple is AAA rated by Moody's, but falls short by S&P assumptions. Okay, so that's it basically for this video, for the final part of the financial analysis. I hope you enjoyed this kind of three-part video, of going through the income statement, the cash flow statement, and the balance sheet. I hope you learnt a lot, and I hope it sort of introduced you into the world of stock picking and sort of what it takes and what to look for, and I hope that sort of you can take this information, you can take it further, and you can go into more depth and more higher study into company analysis, because if you can put the time in and the hard work in it, it really can be very, very rewarding business. This is the one business that really the amount of money you can make is infinite. It really is. The returns that you can get is just absolutely outstanding. Some people, being Peter Lynch, Joel Greenberg, there's loads. They've made absolutely huge money. So I'm just going to put in a few sort of screenshots for you to look at sort of model balance sheets of a company. And just different models of income statement and balance sheet of basically the difference between a company with a competitive advantage and a non-competitive advantage. Hope you enjoyed, and until next time.